So yeah, the JSE specifically focused on geography of COVID-19 related items. So where an entity might have called COVID-19 related items or called them out, I suppose, in the income statement and referred to them as exceptional items or highlighted those items. So yeah, there's both scrutiny on the measurement of those particular items. So is it how accurately can COVID-19 implications be identified and split out? And do they not become part of the trading activities of an entity in any event going forward? The number 5 item here is quite a unique or new item that the JSE has identified. And this is what they refer to as negative confirmations. Now, a negative confirmation means that if an entity states that they're not impacted by COVID-19 or other shock events like the civil unrest, they have to explain why that is. So this could either be in a going concern note or an additional narrative within the financial statements. Interesting that this type of negative confirmation spills over to the disclosure that the JSE have highlighted or recommended in their climate disclosure guidance, which was issued end of last year, where the same statement is made that the JSE recommends that companies who believe they're not impacted by climate change make a statement to that extent and explain to the user why that is. Also, explain to the user the time horizon they've applied to make that assessment. Over to you for the last one, Shira.
Thanks, Ronal. The last finding pertains to debt covenant, and we're going to unpack this in a bit more depth on the next slide. Now, with every type of finding that the JSE has, there's always a background story. Now, previously, the JSE had inquired from issuers what exactly their debt covenant triggers were through a back and forth process, which happened quite intimately behind the scenes. And in inquiring of a very specific issuer, what those exact debt covenants were, what were those externally imposed capital restrictions, the JSE had found out that, very shockingly, this entity was dangerously close, if not already in breach of certain debt covenants. Now, naturally, this can create a whole host of financial reporting issues, ranging from a very grave and serious going concern issue to a current non-current split on your balance sheet, which would then in turn knock on to some of your liquidity concerns. So after that very alarming finding, the JSE decided to raise this as a particular focus area, really zooming in on what exactly are your debt covenant triggers. How close are you to breaching those debt covenants? And what is the board's actual view of the quantum of debt the entity currently has? The JSE specifically raised these concerns in a September 2020 letter to issuers, articulating the appropriate IFRS references under which these externally imposed capital requirements are actually mandated by IFRS. As you can see on the screen, it comes under the ambit of going concern, capital management disclosures, as well as liquidity. Something to be noted is, I'm sure you can imagine from my last comment and this one, is I keep referring back to JSE letters. Now, these are not pieces of paper. They connect a lot of weight, a lot of gravity behind them, and the JSE is clearly tracking people's implementation of these letters, not just within the financial statements, but within interim reports as well. A specific example is the JSE writing to a certain issuer inquiring as to where was their debt covenant disclosure contained within the interim report. So people thinking about their interim financial statements, watch out for debt covenant disclosures. If we move on to the next slide, Ronal is going to kick us off and take us through a refresher on some of the areas of focus for the prior years by the JSE. Back to you, Ronal.
Thank you, Shira. So unfortunately, or fortunately, the report does not only refer to findings in the current year, it makes reference to a whole host of findings that are recurring. Now, in order to assist audit committee members in assessing these recurring findings, they've also issued a summary report, which captures the 2011 to 2019 reports into one summary. Now, the recurring findings that remain relevant firstly relate to the presentation of financial statements. So yeah, entities are still not including all the information around judgments they make when applying accounting policies. Also, the JSE noted that for unusual transactions, say, for example, business combinations or things that are not recurring, accounting policies are often missing. Then, in addition to that, significant and complex transactions often lack sufficient information to explain the extent of those transactions. The JSE also noted that there's not sufficient disclosure often around going concern assumptions, and that links back to our COVID-19 and shock event analysis as well. And then thirdly, or lastly, there's no consistency of the presentation between notes. So the JSE looks at the financials holistically and comments then on the consistency between particular notes within the financials. So watch out for that consistency. Perhaps take a step back and look at, for example, repeat accounting policies, boilerplate accounting policies, and see if those can't be streamlined within the financial statements. Then the next topic on fair value measurement. The JSE again noted that there's partial or entire omission of significant unobservable inputs. So those would be for recurring fair value measures on, for example, investment properties, biological assets, things that are non-financial, but that are measured based on unobservable inputs, so not market specific data. So that could even be unlisted equities. Secondly, there's no sensitivity analysis around these inputs, especially if they're the inputs create sensitivity within the values, and then over aggregation of disclosed inputs. So make sure that those are in sufficient detail, specifically on material balances, to allow the users to assess the information appropriately. Financial instrument disclosure, you saw that was on our initial list. Definitely a repeat offender. There, the JSE said there's still omissions on ECL assessments, or expected credit loss assessments. We're focusing quite a bit on expected credit loss for trade receivables, but other receivables often remain at the back foot, and we don't discuss ECL on other receivables. There's no entity-specific disclosures on inputs and assumptions or forward-looking information. Many entities just state that they take forward-looking information in account in assessing ECL or expected credit loss, but they don't say exactly how, so that is one missing disclosure. And then lastly, there's no information that explains how changes in the gross carrying amount of receivables contributed to the change in expected credit loss. There's some narrative missing on the story of expected credit loss. Over to you for the last three, Ishia.
Thanks, Ronelle. So at the bottom of that slide, one back, we can see impairment of assets. Now, IAS 36 is the standard that covers impairments of assets, and this is frequently on the JSE's radar, so much so that one often wonders if our very application of IAS 36 seems to be impaired. What specifically are we talking about when it comes to these IAS 36 disclosure deficiencies? Well, specific on the JSE radar is significant changes in assumptions. So those are the valuation estimates that underpin the recoverable amount as determined in terms of IAS 36. It's also watching out for the extent of headroom under potential impairment. Was it a narrow escape to which we need to give a bit more sensitivity disclosures, or did we have a wide berth? Remember, the key principle is that where a reasonably possible change in a key assumption might lead to an impairment, we need a bit more information to articulate how sensitive that underlying calculation is. If I move on to the revenue disclosure section, what was the issue there? Well, this is a disaggregation of revenue issue. Remember, IFRS 15 says you need to give your revenue disaggregation in a manner that helps depict the nature, timing, and amount of revenue. Disaggregation can be based on your type of product, your sales channel, as well as your geographical considerations. The JSE also issued a reminder that the same level of revenue disaggregation is required in your interim financial statements when considering your annual financial statements. But not to forget the tax rate reconciliation, the best or the worst finding for last on this slide. What's the problem with the tax rate reconciliation? Well, it's almost threefold. The first issue was that the JSE found that the current tax rate reconciliations provided by issuers were not necessarily providing meaningful information for those that are part of multiple tax jurisdictions. So if your operations are spread across a spectrum of jurisdictions, each with significantly different tax rates, to what extent is doing a single tax rate recon based on a rate of 28% actually providing you with that meaningful level of information? The second problem related to over aggregation of items, that mysterious other items line within a tax rate reconciliation that needs to be unpacked a bit further. And last but not least, a more broader IAS 12 issue, not necessarily confined to the tax rate reconciliation, links to the entity-specific disclosures that link back to any recognized deferred tax assets, another very funny item on the balance sheet. If we move to the next slide, we have another poll. There's no correct answer for this one, but on our next poll, we're asking, have any of the companies you serve received letters from the JSE? You can vote yes or no. Let's see how active the JSE has been in terms of reaching out to our issuers. I can see people commenting yes, yes. If you prefer not to write in the chat box, you can also vote in our poll, which has gone live. If you click on the little triangle, square, and circle next to the speech bubble, and you go to the polls option, you can vote yes or no. I can see a couple votes coming in, 2 votes for yes, 2 votes for no, 4 votes for yes. Oh, so the JC is quite active, and it seems like our audience today has actually received some type of communication. Around 5 participants saying yes, they have received communication. Very, very interesting. So hopefully the topics today are quite pertinent and will enable you to have some good conversations with the JSE should they ever reach out to you. But hopefully not, because your financial statements will be top quality after the session. Moving to the next slide, we're going to unpack a bit more of the material cases. So these are almost case studies that spell out the nature and extent of mistakes that some issuers have made when it comes to the JSE. They say one should always learn from a mistake. That doesn't necessarily have to be your mistake. So let's spell out in detail what some of the key learning principles are from these prior errors. The first material case we will focus on is headline earnings per share, or HEPS. In this instance, the JSE identified 2 instances where items were erroneously excluded from HEPS. Now, the key principle that I want to flag to you today when it comes to HEPS is that if there's any area in the universe of financial reporting for South African reporters, HEPS is one of the single most areas where principles and judgment are not permitted. HEPS is integrally rule driven. Therefore, applying any level of discretion or applying any in substance argument when preparing your HEPS number, calculating that HEPS number, doing your reconciliation is not permitted. The HEPS circular is rules based. In this particular scenario, we had an issuer blur the lines about whether or not the impairment of some loans or financial assistance provided to an associate was an impairment under expected credit losses, or whether or not it was in fact an IAS 36 impairment of the investment into that underlying associate. They argued that in substance, this impairment was actually in terms of IAS 36. So, a key reminder, the circular is rules-based. In fact, that impairment was technically an IFRS 9 ECL impairment, which should not have been adjusted out of HEPS. Remember to also use the latest circular. Remember, there is an updated 2021 circular, which we should be referring to when it comes to HEPS. But over to you, Ronald, to take us through the next case.
Thank you, Shreya. The next case relates to a matter which is often quite complicated, and that is the relationship between the group and structured entities or special purpose entities. In this particular finding, the special purpose entity in this case, which is a trust, was set up by the investor. What transpired subsequently was that bank funding or external funding was obtained by the trust, and the investor provided financial guarantees to the bank should the trust default on their debt. Now, in this case, even though the investor might not have a direct interest in the trust, or the trustees might not be representatives of the investor, it was still found that the trust was controlled by the investor. So really watch out for structured entities. Look holistically at all the relationships between the investor and structured entities. And something like a financial guarantee could get you to control and therefore consolidation. Very lastly, we'd like to touch on the focus areas for 2022, if we can move on to the next slide. I think we're going to skip this poll just in the interest of time. So if we move on to the detail of the emerging focus areas for 2022, you can see that COVID-19 is still on the agenda. Shreya, what is the JSE looking out for when they do reviews for the 2022 year?
Thanks, Ronal. The JSE remains primarily interested in telling the story. Now, not to repeat my earlier discussion around the impact of COVID-19 and estimates and judgments, here what the JSE is looking at is the manner in which we articulate any type of funny expenses that we ring fence and say are attributable to COVID or COVID-19. So, a very specific example comes in when you're reporting deviations from normal operations. So, in a specific case, an issuer said, well, these are my COVID-19 deviations when compared to my normal capacity, my budget, and any deviations of my actual results to my budget are ring fence, and this is the COVID-19 impact. Now, the JSE was very skeptical about this because there's way too many moving parts and uncertainties for such a simplistic approach to actually lead to faithful representation. An issuer would need to have absolute confidence in their underlying financial controls and a very sophisticated budgeting system to ensure that underlying budget was not a stretch and to be able to say any and all deviations from budget are attributable to COVID-19. Also, stay away from flowery, fantastic language as extraordinary expenses or abnormal expenses when talking about these additional costs relating to COVID-19 and the civil unrest. As a tip, rather keep it factual. The JSE just wants you to describe it as the nature. So what is the actual nature of these additional expenses? If the word is too long, chances are the JSE is going to question you. So keep it factual, keep it straightforward, and tell your respective story when it comes to these shock events. Back to you, Ronald, to take us through the primary statements.
Thank you, Shreya. So the last three items relate to presentation on the primary financials, and specifically the income statement or statement of comprehensive income. The statement of comprehensive income is back on the table, and the JSE is scrutinizing the expenses and the subtotals, and whether these are categorized according to nature or according to function. So watch out. We've seen a number of letters come through to the respective issuers, for example, questioning line items such as impairment on associates, which find themselves in a line above, say, operating income, where the actual income or profit or loss from the associate finds itself lower down in the geography of the income statement. The other area that the JSE is scrutinizing is subtotals. Are those subtotals, for example, non-IFRS measures such as EBITDA? Are they properly defined and properly used or comparable year on year? So those are the items to look out for, focus areas for 2022. That really wraps up our whirlwind tour of the JSE Proactive Monitoring Report. I'm going to hand back to you, Werner. for the next session.
Thank you. Thank you so much. Yes, indeed. And I think really helpful. I know a lot of our guests are probably in the midst or may have just completed or about to do a proper review as part of their duties after financial statements. So I think very helpful to get these bits. Maybe just to invite, if there are any questions as you sort of reflect on this session, please use the chat box to put those in, and we can come back to them at the end to Shreya and Runel. Right. I think over to Kyle. If you're ready, if you can come up off mute and camera on. Kyle is one of our tax technical partners in the firm. He's also a tax policy leader for PwC Africa, and he works very closely with National Treasury and SARS on matters of tax policy and tax design, and he's also a member of our global firm's tax policy network. So Kyle, over to you. Thank you.
Thanks, Werner. If we could just move to the next slide. There we go. Thank you. I'm going to go through this fairly quickly. As you'll note, there are just a whole bunch of bullet points here, and I'll try and flesh some of those things out for you. But if you do have any questions, please feel free to either raise your hand or raise them, or raise questions at the end, or put questions into the chat box, and I will try and address those as well. The first thing I just want to talk about is around, insofar as the corporate tax landscape is concerned, is around what's happening from a base broadening reform perspective. So over the last couple of years, Treasury has been very clear in terms of where it's going from a policy perspective when it comes to corporate tax. And what they're trying to ultimately achieve is levying tax across a broader base, while also levying that tax at a lower rate than our current rate of 28%. Many of you would recall that in last year's budget, it was announced that the tax rate would be reduced to 27% with effect from 1 April this year. That reduction in tax rates was explicitly connected or linked to two base broadening reforms, which were actually legislated during the course of last year. The first one was in relation to an expanded interest deduction limitation rule, which basically says that your deduction for interest for connected person debt, where that interest is subject to tax at a rate of less than 15%, would be limited to an effective 30% of a tax equivalent EBITDA, if you like, in simplistic terms. And I certainly don't want to get into the nitty-gritty details of that, but that's what it is in a nutshell. The second base broadening measure that was legislated during the course of last year was a limitation on the utilization of assessed losses to 80% of current year taxable income before taking into account any deduction for assessed losses. So, i.e., even if you happen to be in a tax loss position in year one, year two comes along, you make a taxable profit in year two, and not looking at it in isolation, you will then still pay tax on 20% of that year two profit, notwithstanding that you have losses available for offset against that from year one. So again, as I say, limiting it to that offset to 80% of current year taxable profits. So those are the two base broadening measures, as I say, explicitly linked to the reduction in the corporate tax rate to 27%. What transpired during the course of last year, given the economic fallout from the pandemic, is that those two base broadening measures have been postponed to a date yet to be determined. What does that mean insofar as the reduction in the corporate tax rate is concerned? Well, the way we read it is that the reduction in the corporate tax rate will also be deferred, again, to a date to be determined. We would expect that at the earliest will be now 2023 rather than the previously announced 2022. and we would expect that an announcement to that effect will be made in this year's budget, again with no defined date, but we only expect to get certainty in terms of date in earliest, in budget 2023, insofar as that's concerned. So unfortunately, that rate reduction that we're all looking forward to has, as I say, is likely to be postponed. And the reason for that is really to provide space for the economic recovery, particularly for those companies that are in loss positions. Most notably, of course, the likes of the hospitality sector. The other aspect that Treasury is looking at from a base broadening perspective is around incentives. So again, in the last couple of years, they've been stating explicitly that they intend to review all incentives as they come up for expiry or renewal. Treasury has, for the most part, introduced sunset dates for most incentives, in effect to force them to be reviewed. And there are a number of incentives that are currently undergoing a process of review. And they include such things as the R&D, research and development incentive, learnership allowances, and a number of really fairly limited capital allowances, such as port assets and rolling stock, and so on as well. So those are all being subjected to review currently as we speak. The way we read that as well, that also talks into the issue of broadening the base and lowering the tax rate over time on a tax neutral basis. So we would expect, as incentives are discontinued, if you like, that the tax savings for the fiscus that arise from that would be recycled back in the form of a lower corporate tax rate over time. Ultimately, the expectation, and I think the wish, is that the corporate tax rate goes down to 25% over the medium term. The second aspect that I want to deal with is around the OECD BEPs project. I'm sure that you're all aware of that, at least at a high level. There are a number of critical aspects that are taking place insofar as that's concerned. Loosely what we refer to as BEPS 2, which is divided into two pillars. The first pillar, which is really of limited interest, if of interest at all to South African corporates, is around the formula apportionment of profits to markets. This is what you would have heard about, is around the digital economy and the reallocation of profits from digital services to market jurisdictions. So that is ongoing. There are significant doubts as to whether that will ever actually see the light of day, but some progress is being made insofar as that's concerned. The aspect that is of more interest to South African corporates and is coming at a rapid rate of knots is what is referred to as Pillar 2. And this is essentially the introduction of a global minimum effective tax rate of 15%. So numerous South African corporates are going to be impacted by this to a greater or lesser extent. That legislation, it's intended that this will be implemented on a global basis with effect from the beginning of 2023. Which means that legislation and domestic legislation is required for this, and that domestic legislation will need to be introduced during the course of this year if it's to come into effect next year. So definitely something to watch out for. There are still a lot of moving parts in relation to that, a lot of uncertainty still in terms of what the impact will be and what the final rules will look like. Something to, as I say, something to keep an eye on. It may significantly impact many South African multinationals and ultimately impact the effective tax rates in the financial statements as well. The third aspect to watch out for is country by country reporting. I think, as you would be aware, for a number of certain multinationals above a threshold. There is required country-by-country reporting, which goes to the tax authorities and is shared with tax authorities globally. Currently, that is not public, but to be aware that public country-by-country reporting, again, is also coming at a rapid pace. The EU, during the course of last year, introduced compulsory country-by-country reporting, again, for certain multinational groups as well, with presence in the EU. So that is something to watch out for. And then finally, transfer pricing. Everything that I've been talking about in the last couple of minutes is transfer pricing related to a greater or lesser extent, but transfer pricing remains a hot focus and a hot topic, certainly from a South African Revenue Service perspective, and from a global perspective as well. So a lot of focus on transfer pricing, and it remains a major area of risk for most multinational groups, given the focus thereon. Let me pause there in the interest of time, and if there are no questions, I'll pass the ball back to Werner.
Carl, thank you very much. And please feel free to post those questions. We've got 10 minutes or so, just a bit more, pretty much on time. So do want to leave a little bit of space there towards the end for some open Q&A. Right. I guess our third and last section, just having a quick look at the director's responsibility on financial controls. On the next slide, what I've done, maybe a quick poll, if I may ask folks, you can post answers in chats or just go to the polling question, whether or not you needed to do additional disclosures to communicate certain important financial reporting issues or remediation, maybe yes, no, or not applicable to your organization. So maybe take a few seconds to answer that. Good, let's see. Right, so looks like we've got one organization perhaps that had to do with some additional disclosures. All right, okay, that's interesting. Very good. Let's go to the next slide, please. What I've done here was really just summarize 5 areas where certainly from our experience, as well as some interaction with the JSE, to listen to some of their feedback, where I think we still see quite a bit of effort going into, let's call it our IFC, Financial Reporting Controls programs. The first one was around fraud, and the expectation that the financial reporting fraud risk assessment should be part of the overall financial reporting risk assessment. I think a lot of our organizations have in year 2 progressed even further in terms of maturity of getting to the real problem areas from a financial reporting risk assessment, but make sure that the fraud risk assessment actually comes out of that, and takes a separate look at perhaps scenarios, incentives and pressures from a fraud risk perspective, and that the associated controls are indeed correctly mapped out and as part of the assessment. I think for audit committees in particular, to challenge the assurance plan and monitor the results and remediation on a quarterly basis. I think most of our clients at least have a program now where the IFCs are being looked at. It's part of a plan at the start of the year. The audit committee has a view on that, make sure that that is the right level of assurance they expect, and the work happens through the year, and we get at least quarterly feedback on that assurance plan and any specific remediation coming out of that. Number 3, situations involving a group. I think from our experience, again, there's probably still quite a bit of ongoing effort to implement and to mature the internal controls at the subsidiary level to ensure that material information has been provided to effectively prepare the group financial statements and its support then of the attestation at group level. Fourth one, more effort required to consider that all deficiencies that have an impact on financial reporting have indeed been considered. And for some reason, I think that remains quite a bit of an exercise to not only consider those deficiencies identified by the financial reporting controls program, but also those identified by internal audit, by some of the other assurance providers, risk functions, compliance, forensics, and very important, also those identified by external audit through their work, both at a root cause analysis level, adjusted and unadjusted, as well as any other control observations communicated. So I think making sure we get all of those a good aggregate view of all deficiencies that may have an impact on financial reporting. For now.
Thanks, Werner. And I think it's interesting in our discussion with the JSE, to bring it back to the financial reporting side, is that they do look quite carefully at the letters that issuers write to them in terms of restatements. So the requirement obviously excludes restatements because of new standards, but where there might have been errors or restatements, the letter with the reason for it and the mitigating action is something they look at carefully. And as you mentioned, all those the peripheral implications specifically around restatements in financial statements, what that implication might be on financial controls is something that they look at as well.
Indeed, indeed. Thank you, Ronelle. And then the last bullet is part of the deficiency evaluation process. Perhaps an area where we've got less formal guidance or methodology in some organizations. When we do have deficiencies, how do we really evaluate the impact of those? As you're aware, we really need to disclose more around material weaknesses, but the evidencing process, the evaluation process needs to be quite robust and persuasive. Basically taking each of these deficiencies, identify the potential or maximum impact in terms of error, and then point to some of the compensating or mitigating controls in that discussion. And there will be qualitative and quantitative arguments made to make sure that it is quite persuasive to say our conclusion is that that deficiency is only a deficiency or perhaps significant, and has been elevated to those in charge of governance, but not a material weakness. And I think that process sometimes still needs some maturing. So that's just a couple of thoughts on the IFC attestation, and hence the question at the start there, just to see whether there was any need to provide any additional disclosure. I think in our discussion, Ronelle, with the JSE, I think there was one issuer that attempted to adjust the wording of the attestation and was asked to go back and fix that. And actually, in doing so, by changing the wording, it just raised a lot of questions. You know, why is it you actually change the wording despite the fact that you're not supposed to? Is this something that we need to know or read between the lines? So other than that, I think just a couple of cases where additional disclosures were made in the Audit Committee report, and typically perhaps a correlating disclosure also in the CAM. So those are just a couple of thoughts there, but keen to hear any questions. We've got a couple of minutes left for any remaining questions. And while we do that, maybe to also ask the team, I believe we're going to put the feedback form in the chat box. If you do have a last couple of half a minute towards the end, please give us some feedback. We really look at the feedback, both in terms of format, structure. Please indicate topics that you think would be helpful to yourselves. We look at all of those in how we put the next event together. And then also coming out from Nishant will be the CPE certificates. And with that, also a copy of the slides. I think we started the recording a little bit late. I do apologize for that. So we will share the slides so you have them as well for reference. And if you want to share it with other audit committee members, please feel free to do so. And I think all of us, Ronel, Shreya, Kyle, if there's any other questions, you can pass those on to us as well. Happy to pick up the phone or set something up separately if there's some more specific discussions needed. So I think from all of us, thank you very much. It was really good to see everyone. If there are any questions, just want to quickly go to the message box. I don't see anything coming in right now. Good. So if I may ask again, please take a little bit of time for the feedback, and we'll also share the feedback form as well to please complete that when we send through the deck and the CPE certificates. Right. I think we are on time. I think people are leaving. They're probably getting ready for their 10 o'clock. So I think from our side, again, thank you very much for attending. And please look forward for the next event. Good. Thank you. Thanks, everyone. Have a wonderful day further. Thank you. Bye.